Regulated booms and busts. What do they mean for our financial outlook? Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Sam, who's been looking into detail at the regulators in the space, particularly the SEC and the CFTC, who are these bodies that sort of oversee everything and make the rules and determine what can and can't happen. So it's an interesting discussion that I've been really looking forward to having because there's been some things that have been annoying me recently. So welcome back, Sam. How are you going?
Great. How are you, Chris?
Yeah, I'm really good. I was reading your piece this morning and it boiled my blood a little bit just because I was watching CNBC the other night and when Gary Gensler was on there talking specifically about crypto, and it was just, I found it so outrageous because we had here a government organization that was saying we're going to bring these companies to account for not following the rules, and the companies were saying, but we've been trying to ask you what the rules are for ages, you won't tell us what the rules are. So it's like, you've got to follow these rules, but won't tell you what they are. It all seemed like a massive mess. And that's crypto. I know you're specifically were looking at the metals in the one today, but these organizations, they do my head in.
Yes, and it's something we hear about more recently. It's not something you'd hear about too much in the past. Whether that's because it's better publicized now, who knows? But if you look into the history of financial regulation in the US, in January 1920, something called the SEC was formed in the United States. And that was called the Securities Exchange Company. Now, that was
Oh,
formed to regulate the sale of securities inside of the United States, which sounds great, right?
yeah.
Now, the man who started the SEC, his name was Charles Ponzi, the Charles Ponzi. So,
The Charles
that,
Ponzi.
yes, so the one the scheme is now named after, because he was essentially using this SEC as a vehicle to promote his scheme and regulate it. Now, obviously, this all fell apart, and later the SEC we know today was opened shortly afterwards to try to do the opposite. So,
So what does the SEC actually do? Are they like, there's so many products and it seems like their tentacles stretch ever broader. And I know that's what's being brought to a head with crypto. What are they actually responsible for? What do they do?
well, they're supposed to protect consumers. They're supposed to help regulate the essentially the sale of securities and make sure, for example, no one's swinging the market too high or too low. And they were started after the huge crash um, in the early 1900s. So that's their stated goal, is to try to essentially stabilize markets. How well they've been doing at that, look, I'm not 100% sure. There have been plenty of booms and busts. And for example, if you go to the usdebtclock.org, you can actually see something. It's kind of hidden in the bottom right corner, but you can see something called the paper to gold ratio. Now, that compares the number of paper ETFs or paper gold. When people oftentimes buy gold, it's not like how we sell it in physical bullion. They just put some aside in paper gold. It says you own 1 ounce of gold or you own 100 ounces of gold, and then they just sell the paper to someone else. But if you look at the paper to gold ratio currently, according to usdebtclock.org, it's about 123 to 1. So what that
Wow.
means is if you went out and bought 123 ETFs for, say, an ounce of gold, one of them statistically would be actually backed by gold.
And that's what I can't understand that really, how that regulation allows that to happen. That's something I can't get my head around, because you would think that if your job is to align the safety of consumers, for example, I mean, most consumers, when they think they're buying gold, using gold as the example, would think that there's some gold on the other end of that contract, surely.
Well, that's what you hope for. And people who follow the history of fiat currency know that the whole paper money came from, it's supposed to be backed by gold, but then the goldsmiths or the owners of the big vault realized that no one actually comes and claims their gold out, so you can start printing more papers than you have gold for. And that's essentially what's happened in the ETF market. If you look at the silver market, it's even worse. You know, gold is shocking. It's 123 to 1, according to the data right now. Silver is 346 to 1.
That's outrageous.
And
Wow.
you mentioned comparing to crypto, because crypto is a little bit more like a cowboy industry now, it's thought of. But if you put that into perspective against crypto, the paper to crypto ratio is only 18 to 1. So these
Well,
regulators have been
yeah.
around for ages, yet they're many multiples worse than crypto.
And I find that really interesting because even the song and dance that Gensler was saying on that interview the other night about crypto, you go, yeah, he was actually making the point saying that if people knew that these other institutions were basically running a Ponzi scheme, and that's fascinating, isn't it? Where this all comes from. But if they knew that they were running a Ponzi scheme in these other institutions, we'd lose faith in the whole system. Was what he was effectively saying. So we have to squish down crypto. Yet he's sort of overseeing that exact same thing happening at a much bigger scale in the gold and silver markets, from what you've just described.
Yes, and they love the word Ponzi. They should do a Google search of the
of,
term SEC and do some reading.
of their own background. So I just want to change direction slightly. In the article today, you specifically mentioned the term tamp down, and I thought that was something that was really interesting because that's not something that I was particularly aware of how that was used in this context. So particularly you're talking about tamping down silver. Can you talk to us a little bit about what that means?
Yeah, so that was Rostin Benham in his interview, which there's a YouTube link to, and they were talking about the silver situation. Now, the situation was silver was going up against the US dollar, and they saw this as some sort of crisis, and it had to be fixed or remedied. So tamp down, you know, the word tamp isn't used very much recently. If you see your barista making coffee, the thing they crush down the coffee with is called a tamp. But according to Merriam-Webster dictionary, tamp is a verb, and it means to drive down by a succession of light or medium blows. So essentially, it's a pretty harsh word, meaning to knock something down repeatedly. And if you look at the silver price, whenever it has tended to pop, you can see it being knocked down. So how's that being knocked down? Well, if you look at what moves the market, it's essentially the tail wagging the dog. We have
Hmm.
these paper silver contracts, which are pushing down the price of silver. And this is all with essentially fake money. It's with fake contracts. So it's interesting to see why they would say that's a good thing. And there are two reasons I think that they want to tamp down the price. And one is that precious metals like silver and gold as well, they're inflation hedges. So
Yeah.
in times of high inflation, that's going to mean people are going to be running to gold and silver and away from the currency. So that would speed up the collapse of a fiat currency. The other one is lack of control. You can control monetary policy. If you want to make people spend or not spend, you simply raise the interest rate or lower the interest rate, and that sends shockwaves throughout the system, which we're seeing now. But with gold and silver, especially if someone has physical gold or silver, how do you convince someone to go out and sell all their gold or silver for a really bad price? I mean, it's hard. People tend to want to sit on it and hold it, which is why they have to go out and do these fake contracts.
And I was having a discussion with a group the other night when we'd gone to speak to them about what we do at Ainslie and different things, and there was a question about this specifically, and this idea of suppressing the price. And I was saying, so when that's all highlighted, as it was, because remember there were actual sort of convictions made that this was going on, and identifying that in the courts even, why didn't the price rocket up? And I said, like, I wonder if it adds to what you've just said there to say that because this has gone on for so long, this idea of tamping down that you've described, does that create sort of its own, people just lose sentiment? You've got this idea that, oh, they give up a little bit on the metals and go, well, oh, they all, they haven't really moved up. It's that capitulation idea, you give up, you capitulate when you've waited for years and the price hasn't really taken off like it should, so does that sort of undermine everyone's thinking on it? And I suppose that leads me to the next question. What comes out of that? Does that ultimately result in higher volatility? Because my response to them was, well, eventually you can't hold that down forever, and eventually the price does correct to where it should be, and that means silver, specifically silver, rips to the upside. So, as it sort of blows off all of that and just proves that Ponzi was unsustainable. Is that how you see it?
Yeah, well, one point is, firstly, there are little mini cycles where things pop and then fall back down and eventually burst and recorrect. We can see that everywhere. We can see that in the stock market when something's way overvalued, maybe some sort of social networking or some tech company that runs at a loss and doesn't really do anything, eventually corrects lower, or things like precious metals, which can get suppressed and eventually bounce higher. All you have to do is change your chart and look at daily or weekly charts instead of looking at the last few hours or the last just couple years. Just look at the big picture. Now, with volatility for years, traders, not only in the precious metals markets, but also shares in other markets as well, have complained to me. They said, it's too volatile to trade. These big guys are pushing around the market. The regulators are pushing around the market. They're making it go up and down. It's too boom and bust. It's too bad to trade it. And I have to say, well, hang on. That's a good thing. If you're a trader, if you're an investor, I mean, that's like a surfer saying, oh, there are too many waves. You can't surf if there aren't any waves. So there's always something to complain about, I guess. It's too hot, it's too cold, or the market's too volatile, it's too flat. But as a trader, as someone who has researched what money really is, figure out what value really is, what precious metals do, where shares get their value, these sorts of things, and you've actually gone in and decided to move some money into precious metals, move it back into fiat, back and forth. As an investor, you want to see as much volatility as possible because that's how wealth is made in financial transactions. If we lived in a perfect world, so say the bullion industry runs the world, it's a gold and silver backed currency, no printing, no dodgy speculators or anything like that. The market's perfectly static. Well, trading would be extremely boring.
Yep.
You wouldn't be looking at any charts or anything. You'd just be working and saving. So look, we're in a different world, but that means different opportunities where if you've taken the time to figure out, which most people haven't, things like inflation, what does quantitative easing actually mean? Where can you go out of the system where most people are doing something else, and what is that going to mean for your investment? So it's actually a really positive thing that these big booms and busts occurs, and the more they happen, the better, because you change fiat into gold or silver, it goes up, and then before it gets knocked back down, change it back and then buy again. It's just more opportunities, really.
That's a really good point. So if you are paying attention, and I mean, that's what we're attempting to do here, is to have people just give that little bit more thought to it. The opportunity does come from almost the bad actors in a way, doesn't it? Because if that volatility, as you've described, creates the opportunity for the price to be suppressed, which gives you an opportunity to load up, and then you get that corresponding face ripping rally that comes out of these things. That is actually quite exciting. Do you think this can go on forever? Is this a sustainable sort of model for people who are looking at investing?
Face ripping rally. Okay, I like it. I like that term. But look, if left unchecked, so if these regulators just kind of let off and then interest rates eventually get cut, which is what everyone's looking for this year, when are they going to flip? When are they going to give in to the it's almost an undeniable sort of urge to keep printing more money.
Yep.
When are they going to give in and cut interest rates? And are the regulators going to try to keep tamping down prices of precious metals? Well, look, if they let off a little bit, there could be a steady, aggressive rise in the metals markets as more money keeps being created. But if they try to very overtly tamp down markets again, okay, maybe they're successful. Maybe we have a little bit of sideways movement with some kind of mini pops upward and pushes back down. But eventually that could lead to a situation where it's like if someone's trying to hold a beach ball underwater,
Yeah.
Eventually when they lose grip, it could be a face ripping rally, like you mentioned.
That's where we get it. Yeah. Yeah.
A major correction upward. And for an investor, look, the only thing that's on your side really is just time. It's just waiting to see how they react and the inevitability of them losing grip on that beach ball, whether they let go gradually or they try as hard as they can to hold it down and accidentally slip and it goes flying upward.
Well, I'm looking forward to that explosive beach ball popping out of the water anytime now. So thank you for all of that today, Sam. I found that to be a really interesting discussion. I love the positivity, actually, because it can be frustrating. I started off talking about how frustrating it was just listening to Gary Gensler, the chair of the SEC, saying things that I thought made no sense and were just unfair. But as you've pointed out, there's opportunity where there's that chaos. So thank you for that.
Yep, that's it. That's absolutely right. Thanks, Chris.
All right. Thanks everyone for watching. Remember, reach out with any questions or comments. We're happy to get back to you on those as soon as we can. That's us for this week. We'll be back on Monday with Alex to continue digging down the rabbit hole of all things markets and metals. So until then, stay safe in the market, everyone, and have a great weekend.